Okay, today we're getting into one of my favorite tools for investors right now, financing a short-term rental based on what the property earns instead of what your personal tax return says. And we're actually going to run some examples so you can see how it plays out on real numbers.
Which is the part people always want, right? I mean, everybody's heard of a DSCR loan thrown around. What they really haven't seen is somebody that actually sits down and says, here's an address, here's what the potential is, and here's what works, maybe doesn't work.
Exactly. So that's the plan. I'll explain how it works. We'll walk through 3 properties, one that cash flows, one that mostly pays for itself, and ones we would tell you to walk away from, because I'd rather you know in the afternoon than after you've written an offer on the place.
Yes, welcome back to the South Florida Mortgage Report. It's your non-hat dude wearing mortgage guy, Billy Mei, with Craig Garcia, president of Capital Partners Mortgage. We're back, Craig, and so set this up, Craig. Who is this product for?
It's for the investor whose paper income might not tell the real story. They're self-employed, or they write off a lot, or they already got a lot of rental properties that muddy up their debt-to-income ratio. On a traditional loan, that's a wall. The loan qualifies you, and your tax return doesn't cooperate.
Yeah, these folks usually, they're not the ones hurting for money. They've got the down payment, they've got the reserves. They just maybe, like you said, don't show on income in their tax return.
Yeah, it's not a strength problem, it's a documentation problem. So this loan flips it. Instead of qualifying you, the individual, it qualifies the property. It's called a DSCR loan, which is a debt service coverage ratio loan. The lender asks one basic question: does the rent this property brings in cover the mortgage payment? If it does, you're in the conversation. You don't have to have W-2s, tax returns. There's no personal debt-to-income ratio loan.
Yeah, so let's be clear. This is specifically for an investment property.
That's the key. This is a business purpose investment loan. A property you're going to rent, not a home you're going to live in. And that business purpose piece matters for a reason we'll come back to, because it's what lets us do these in most states, not just in Florida.
Interesting. Now, DSCR loans have been around for a while, right? I mean, they're not brand new, but this is a version people maybe have been doing for years. But, how's that traditional path work?
Yeah, that's the important part. Since the very beginning of these loans, the traditional path uses long-term annual rent. The entire basis for the approval is what the appraiser puts down as the market rent. Not what you think it'll rent for, not what the listing agent says. The appraiser's opinion of market rent is the number that the entire deal stands on.
Yeah, and you don't get the number until when in the process?
Until the appraisal comes in. That's the catch. You're hoping the agent did a good enough job estimating the annual rent, but you don't actually know until the appraiser weighs in, after you're under contract, after you paid for the appraisal.
So where does it get sticky?
The rent comps used to sell you the property, often the best ones. The similar sized homes that have been renovated, set up to maximize rent. But an appraiser is going to compare the property that you're buying on the condition, its actual shape, not the renovated showpiece down the street shape, the shape that the property is actually in today. So the market rent can come back lower than the story that you were maybe sold sometimes, and now your deal's suddenly short and you found out at the worst possible time after you're a bit knee deep into the situation.
Yeah, so this short-term rental way really fixes the timing of it.
That's the beauty of this. So you get to find out up front, because here's what most people don't know. On a lot of these, you're not stuck using only long-term lease rent. You can qualify using projected short-term rental income, the nightly rate, like an Airbnb-style income. If you were going to Airbnb a property, what's the projected income using that type of rental information?
Yeah, so if I'm a buyer, I mean, how do we know what the property's going to rent for ahead of time before anybody can book the night?
Yep, that's where our short-term rental income model comes in. It pulls real short-term rental performance for the market, what comparable properties are actually booking, occupancy, nightly rates, and it produces a projected annual revenue for that specific address. And that's the number that we can lean on for the upfront analysis. It's the kind of data the lenders on these loans will accept. We know that investors are going to accept the income that we're looking at before they get under contract.
Yeah, so that upfront is always the operative word, because you want to know this upfront before you go spend money on inspections and appraisals and all that other stuff.
Before you make an offer, before you spent a dime on an appraisal, hoping that the rent number lands. Instead of finding out at the end, you find out at the start. And the part that it surprises experienced agents sometimes, you do this on a purchase. And so you don't need 12 months of existing Airbnb statements. You can do this based off of this projection using this short-term income analysis tool we have.
Yeah. And I mean, not all lenders count the income the same, correct?
No. And that's why, when we run a specific deal, we look at the different options, because some of the investors, they'll take a haircut on this rental amount. They'll use 75% of the projected income to be safe. Others will use the full projection. And so the difference changes how much a given property can carry. And it can be the difference between, hey, this is going to work and this is not going to work.
Yeah. So you said you come back to the business purpose thing.
Yeah. So here's why it matters beyond just qualifying. Because these are business purpose investment loans and they're not consumer home loans, we're able to do them in most states, not only Florida. So if you're listening from outside the market, if you've got a client buying an investment property in another state, it's not a, hey, I can't help you. We probably can't help.
Yeah. And I know some states, they have their own quirks. So we're going to be careful about that. So
Yeah, there's a handful that have their own rules. So we always check the specific state, but the footprint on this is pretty wide. So don't assume that, geography would take you out of us being able to maybe help you out with this.
Interesting. All right. So we're going to take a look at some examples, right?
Yeah. So let's take a look at one that works. And so I kind of put something together. So let me do a screen share here. Okay. So this is a property that I located, and I just pulled one out of the air. That was a property that's listed for sale. This happens to be a property up in Jupiter. It's a single family home. Happens to be not in an HOA. It's a 5-bedroom home. It's being offered at $659,000. So what we're able to figure out is that this property, using the short-term rental income tool that we have, is projected to generate as an Airbnb. This property could generate $92,000 a year in revenue, and its projected occupancy is 66%. So 2/3 of the year you have it booked, is what they're estimating based off of market data. And so if you put 20% down on this as an investor, this would be a property that we know the property would be approved. So in other words, like we already know up front, and this thing, we're estimating it would run, you would estimate, it would throw off cash flow after paying the mortgage payment of almost $800 a month, which on a 20% down investment property deal, that's pretty lucrative.
Yeah.
So, and keep in mind, it's a projection, right? And so this doesn't mean that if you went and got into this property, that's definitely what you'd achieve in terms of rental income. So, any buyer is going to have to do their own diligence when they're looking at properties, understand what all is involved in that, look at the deal themselves. But the point that we're making here today is that there's a path to readily finance this property for an experienced investor who doesn't even need income tax returns to qualify, because this property will qualify for this loan. And we know that today, which is great.
Yeah. No, absolutely. But let's talk about the cost. You had mentioned, in our scenario, we're putting 20% down, but really the cost. And one of the things you touched on too is like the monthly payment. We're really going to look at, and you said it projected too. We're not just using, the current tax bill. I mean, if the property's been homesteaded for a long time, the current tax bill is very low. You know what I mean? We're going off what the projected cost would be for after you own it as an investment property, what tax is going to change. So
that's true. Yeah, some of the investors that we work with, they will look at if they know the property is changing hands from somebody that's a primary residence owner today. So if somebody already has homestead on that property and the property is going to change hands, the investor's already going to make us use what they think that the tax bill is going to go up to. So it's already kind of baked into this analysis here. So
okay.
Is it conservative? Hey, you got to do your own diligence and check, but we are baking in not just, hey, this is a tax bill representative of somebody that's been owning this property for 20 years and they've had a homestead cap on it. So it's an under market tax bill. It's a full-fledged, property tax bill that we're running these estimates on.
So our first example, this is a good one. So our second example is going to be what's next.
So let's look at somebody that maybe it's almost paying for itself. All right, Bill. So here's an example of a property that we looked up that's actually listed by our friend up in the northeast corner of the state, um, Mr. Brad White, the
Yeah, the
rock
rock
and
and
roll
roll
realtor.
realtor.
Yeah. And this one we looked at, and this is a condo, happens to be a condo. It was offered at $272,000. This was projecting income of almost 35,000, 58% projected occupancy. And so this one was actually going to cost some money. Now there's a path for the loan approval in this case actually still, but this one's not going to cover what we're projecting the monthly payment is going to be. There'd actually be a little bit of a cost to it. Now,
Yeah.
an investor who really likes this area or really thinks that they can do better in renting or something like that, it still might be interesting for somebody. Hey, you can own this property and it will pay for itself and it's just going to cost you a few $100s a month. It might be interesting, but at least that's something that we can advise, somebody of upfront.
Yeah.
And there are options where we might still be able to do a loan on a property like this, even though it doesn't cover everything.
Hmm.
But hey, it's helpful, obviously, for a potential investor to understand up front. This is, this is going to be a property that's maybe not going to peel off it maybe as much as another property.
Yeah.
And so it's good to understand. But hey, the idea of owning a beachfront condo looks to be, or very near the beach condo, in St. Augustine, for $400
Yeah.
a month. That's pretty
I,
cool.
I was looking at that myself. I'm thinking to myself, hey, that might be a pretty cool investment. You got a property, and maybe a few times a year you go up there and you have yourself, the same
Hey,
condo right at the beach.
and it's not unusual for people up north to make an investment in a property today that is an investment property that is today, but is also with the potential to become the future primary residence once they
Right.
retire or whatever. And now they've bought it and it mostly paid for itself along the way. And then hey, when they're ready to come down, they already own the property. And now hey,
That's a great point.
yeah, yeah, totally. So, certainly a very handy tool and a very handy strategy.
Yeah.
You just need a good local team if that's your scenario. And
Yeah.
certainly, but there's people that do that all the time. So,
Yeah. That is true. That is true. So we've done two. Now our property, we got our third property.
okay, Bill. So I pulled up just at random, I pulled up a property. It's a lovely property in Coral Springs, a 3-2, 1,600 square foot property. A beautiful home, beautiful looking home. Doesn't even have an HOA fee. How about that? $640,000. So, however, when we run the numbers on this particular property, so I don't have a pretty, or a flyer to show here because when it doesn't make any sense from a financing standpoint on this program, we don't generate one of those. But this one, our tool said on this property, the estimated income annually was about $55,000, a little less than $55,000. And looking at this property with a 20% down payment, was probably going to end up, with a payment, over $5,000. And this was going to be something where you're probably digging into your pocket a bit more.
Yeah.
And it probably wasn't going to be quite as attractive. So this one, we would be telling you up front, hey, this is probably, we still might have a financing option for it, but it's certainly
Yeah.
not going to be as attractive as some of the other options that we just looked at.
Yeah.
So,
Yeah.
but
Because
the
it's
point
costing too
is,
much money. Right.
yeah, but the point is we can find out pretty quick. And sometimes we find out that when we look at some of these properties, we might find out that um, the confidence score on some of this rental income is very low. Sometimes that impacts things, but it's very transparent to us and we can help people very quickly figure this out when they're looking at
Yeah.
these types
And
of
help
transactions.
agents. We have a lot of our subscribers are realtors or agents, and they have listings, and something we can help them because maybe if they're trying to talk and somebody buying his investment property, it may not be a wise move, because like you said, we've done the numbers and it doesn't look like the numbers are there, but so it's just that's something that this kind of it'll change how they list a property. You know what I mean?
Yeah, no, Listen, I think that today, everybody's looking for different ways. And certainly it's not like there's, a overflowing amount of buyers per listing right now. I would
Yeah, true.
and the idea that you can open up a different way to market a property as a listing agent is certainly something I think that's worth paying attention to. And having a specific angle for your regular buyers and this investment buyer crowd that may be out there and trying to cultivate some of those types of people, at least I think shows sellers, hey, you're thinking outside of the box and you're looking at all the different ways that you might be able to help, market their.
Yeah, I mean, because the wording in the MLS, it could turn from a nice pool home into here's what it earns and here's how the investor finances it, and it could open up some money. You could still say nice pool home, but you could also add this in there as well.
Totally. Yeah, that's the thing. And I would say before we would wrap up on this, I'd say there's a couple things we got to respect on these.
Yeah.
We've
These are projections. Okay, this is not set in stone, but it is data. It is data that's scrubbed down. So
it's estimates from market data. It's well informed, but actual short-term rental performance varies. Treat the numbers as projection. It's not a promise. Short-term rental use isn't allowed everywhere. Local ordinances, zonings, an HOA or a condo can restrict or not allow that, and our tool may not pick that up. So obviously, you're going to get into that type of, if this is your angle, you're going to be asking those questions before you put the offer in. And you may have to do a little bit of research in terms of zoning. So
yeah, absolutely. So the bottom line, Craig?
Yep. And it's and again, these are not for a home that you're going to live in. These are for business purpose, investment financing. And loans like this do carry typically a higher rate or fees or both. But that's not always the case. Sometimes you'd be pretty surprised at how reasonably priced some of these loans end up being. But it is different than a 30% down single family property primary residence deal, because that's not what the purpose is. So and every deal is subject to credit. The property, even though we can tell you about the income on the property, the appraisal of the market value of the property is still a variable. And so the property is still going to get appraised, and it still needs to appraise. Otherwise, it could affect, how much your down payment is and everything. So, and we lend on an equal housing opportunity basis, of course.
Of course, absolutely. And like you said, here's a reminder, we can do these in most states. This is not just subject to Florida. The rates and costs, they're very competitive. I mean, this is not drastically different than your regular conventional conforming financing. Very, very competitive. So,
for sure.
But so contact us if you're a prospective buyer, or if you're a realtor and you want us to crunch some numbers. If you have a listing, if you're an agent watching or listening to this, and you have a listing, you want us to crunch some numbers for you, we have this great tool. We can help you market your property. So this is it's an awesome tool.
Absolutely.
All right.
Yeah, and if you think this helps, send it to the investor, the agent in your life who needs to hear it, and we'll see you on the next one.
Yes. Not only see you the next one, we'll see you
at the closing table. Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.